Hey Bowtie Nation, Joseph Hogue here, and if your investing strategy involves scrolling Reddit until someone mentions a stock with a rocket emoji, we need to talk. Because while you're chasing meme stocks and hot tips from your cousin's crypto group chat, a boring little strategy called the 3-fund portfolio has quietly beaten most investors for decades. It's been the go-to investing strategy for Bogleheads, index fund fans, and anyone tired of turning investing into a second job with no pay. This is investing at its most simple and without the BS. No market timing, no spreadsheets that look like NASA launch plans, just 3 simple funds and a strategy that works in bull markets, bear markets, and everything in between. I'll explain that 3-fund portfolio, how to use it, and why it's worked so well, beating the average investor return for decades. I'll also show you an alternative to the 3-fund strategy that's going to boost your returns without losing any of that simplicity or the stress-free appeal. Let's start with the basics, and I'll show you later how to put all this together and even boost your returns. This 3-fund portfolio is a grown-up version of what most investors call investing, chasing a bunch of stocks and hoping they get a decent return. It is a simple, low-cost strategy made up of just 3 exchange-traded funds, a stock market fund, one that covers bonds, and another one that covers real estate stocks. And that is it, just 3 investments, just like the name promises. No gambling on hot stock tips, no chasing headlines, no need to call your cousin's friend that knows a guy on Wall Street. It's the investing equivalent of eating your vegetables. Boring, consistent, and damn good for you. The portfolio was made famous by the Boglehead community, followers of Vanguard founder Jack Bogle, who championed the idea, and it's a favorite among index investing fans as well because it gives you that exposure to the 3 major asset classes, stocks, bonds, and real estate, with just 3 clicks. And hey, just a minute, before your brain checks out at the word bonds, let's talk about returns because this strategy works. Over the last 30 years, a typical 3-fund portfolio with say 60% in the stock fund, 30% in the real estate fund through those REITs, and then 10% in bonds would have produced a 10% annual return. And that's from the 11% long-term average on stocks, 10% on real estate stocks, and then 5% on bonds. And most important though, this would have held up not just in bull markets, but in any market, protecting your downside with bonds when stocks crash. It's because that power of diversification balances out in any scenario. When stocks crash, bonds and real estate soften the fall. When inflation spikes, real estate values keep up. And when the economy grows, it takes stocks with it. Now I know that simple 10% return doesn't seem like much compared to a 1,400% payday on Nvidia over the last 5 years. But let's be honest, folks. Most investors lose money because they try too hard. They chase trends, they time the market, and react to every headline like it's a nuclear winter. Dalbar, the behavioral finance research firm, found the average investor underperformed the market by 3% a year over the last 30. While that 3% gap might not sound too bad, it's something different when you realize that is a $1.3 million difference over time. Nation, that is the cost of panic selling in 2008, FOMO buying in 2021, and sitting in cash until we get better prices, which, spoiler alert, we never get. Instead, the 3-fund portfolio doesn't play games. The stock fund gives you that growth, real estate brings in income and inflation protection, and then the bond fund smooths out the ride. And the best part is, you don't need a finance degree or an awesome bow tie to set this up. You just put your money in 3 ETFs, those exchange-traded funds that trade like stocks, but that give you the broad exposure to the entire asset. These ETFs hold hundreds or even thousands of individual stocks, bonds, or real estate investment trusts, so with just one buy, you get it all. For stocks here, you might go with the Vanguard Total Stock Market ETF, the ticker VTI, which holds over 3,500 stocks traded on the US exchanges. Or for you Fidelity fans, the Fidelity 500 Index Fund, the FXAIX, which holds stocks in the 500 largest companies in the US. For your bonds, I own both the iShares US Aggregate Bond ETF, ticker AGG, with its 12,000 plus bonds, almost half of which are in guaranteed US Treasuries, and the Vanguard Long-Term Bond Fund, the BLV, which holds 3,000 bonds. And while Treasuries make up 52% of these here as well, it also holds corporate bonds to give that fund a higher yield. And for your real estate fund, the Real Estate Sector Spider, ticker XLRE, holds shares of the 31 real estate companies in the S&P 500 index, the largest property stocks in the US. This is the US real estate market. Now, how much you invest in each of these is going to depend on things like your age, how much risk you want to take, and your goals. For most investors, a simple 60-30-10 split is going to work out, where you have 60% of your money in stocks, 30% in real estate, and then 10% in that bond fund. That's going to give you that higher growth with stocks and real estate, but still some cushion with those bonds. For those of you maybe closer to retirement or just that want more safety, you might take 10 or 15% out of your stocks and real estate shares to put more into bonds and less risk. This kind of 50-20-30 split with 30% of your money in bonds would still have produced a 9% annual return over the last 3 decades and would have given you max safety. But I know a lot of you out there want more. You want to reach for a higher return, so I want to give you a few ideas to boost your returns on this 3-fund portfolio without destroying it with risk. For that, I like these 3 strategies that push returns and income, but without blowing up your portfolio. First is just to tilt a little more towards stocks. That 11% long-term return is the highest of the 3 assets, and despite the short-term panics, stocks are going to go higher over decades and more, so instead of holding 60% of your money here, maybe you bump it up to 70% of the portfolio. I'd still hold at least 10% in bonds for that safety, so take a little more from the real estate fund. Another idea here is to add a small cap or an international stock ETF to the mix to boost those returns. The Vanguard Small Cap ETF, ticker VB, has produced a 13% annual return over the last 5 years and gives you exposure to over 1,300 stocks of smaller, faster growing companies. Third here, you can add individual real estate stocks for that higher income, many of which pay dividends as high as 6 or 7%, which doubles the cash flow you're going to get from that XLRE fund. And speaking of stocks that can help boost your 3-fund returns, if you've ever wondered what's in my portfolio or just want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. This is the app we've been waiting for, created for investors by investors. I just started using it last year and love it for getting ideas and sharing my own portfolio. But this isn't just another investing app. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You're also going to be able to join more than 250,000 investors in the social feed to see what everyone else is talking about. I've shared my portfolio on Blossom and it's totally free to download, so look for the special invite link in the description below. Nation, the 3-fund portfolio is rock solid and could be all you need, but I also want to give you an alternative, a way to get those stress-free returns on the strategy, but also still able to pick your stocks and invest. And we're going to do that with the core satellite strategy. And you might recognize that because it's how I manage my own portfolio. Using the core satellite strategy means investing 50 to 65% of your money across the 3 index funds and ETFs in this video. It means you're always going to earn that no worries stock market return along with the cash flows and growth. Now that's the core part of your portfolio and really just this 3-fund portfolio by a different name. Then with the remaining 35 or 45% of your money, you invest in those individual stocks you really like, the ones you think are going to outperform the market. You get that chance to pick stocks that are going to boost your portfolio, but the fact that it's only about a third of your money does some amazing things here. First, with maybe 3 or 5% of your money in each individual stock, means you're only investing in maybe 10 or 15 stocks. That means you're not constantly chasing the next hot stock idea, spending hours of research on each. You find that handful of stocks that you really believe in, and you don't have to watch some Yahoo in a bow tie help you find more. Also, because you've only got maybe 3 or 5% of your money in each individual stock and so much of your portfolio in those broader index funds, you don't have to worry about one stock just destroying your future. You're not losing sleep when that one stock crashes and takes your dreams along with it because you know you're still getting those market returns from that core index fund portion and the growth in those other stocks. I'm going to walk you through my favorite apps to build out your 3-fund portfolio next, but if you're thinking about using that alternative strategy, adding a few more ETFs to the mix, I've got a perfect video for you to watch next. Check out the video linked in the corner here for the one exchange-traded fund I'm buying above all the rest, up 81% over the last year and with more upside to go. It is a great addition to this 3-fund strategy. Building this kind of set-it-and-forget-it portfolio has never been easier with some of the investing apps that we've talked about here on the channel. One of my favorites here is M1 Finance, which lets you set the percentage of your money you want in each fund or stock. So instead of investing by a dollar amount, you just make your deposit and the app is automatically going to split it up among your funds and stocks. And of course, Vanguard and Fidelity both have their own platforms, and with 0 commissions on their ETFs and index funds, it's an easy, low-cost solution. I also have accounts on SoFi and E-Trade, which offer no commission trades on stocks and ETFs. I use E-Trade for the research, which you probably don't need anyway with a simple 3-fund portfolio. But SoFi is a good overall banking and investing app as well. Join me on the Blossom Investing app. See the stocks I'm buying and what 250,000 investors are talking about. All free with the special invite link in the description. Or click on the video to the right to see the one ETF every investor needs in their portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.